All right, so it sure seems like we're in the last week of August, as you can tell from the market standpoint, after this nice little bounce that we had pre-expiration. Just like that, in 2 days, we're back to very low ranges, very low volumes, very low volatility, and just the grinding type move that we talked about on Monday. If we follow through, that's the kind of bullish move we'll get, and that's what we're getting right now. The small cap index and a lot of other risk asset classes are kind of at this point of breakout mode where they're positioned to start a new trend, right? Because remember, the risk asset basket outside of the Qs, which is, or the excuse me, XOK, which is most of QQQ, which is most of XPX. All right. So aside from those three, all the other risk asset classes, which have been acting like a safe haven, actually, have been in risk aversion mode. So they're all kind of pointed toward the potential for a new risk appetite move to occur from here. Nice little a new intermediate leg to occur. They're poised for that, but not quite there yet. So I'm going to show you what that looks like and what that means and what to expect. And then our trade idea is a stock that has broken out, that has been in its own intermediate decline for multiple months. It's got a great breakout pattern. I'm going to show you why I say that and how we're going to trade that. So let's go ahead and get started. Today is Wednesday, August the 25th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. Well, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. You can see the intermediate line turning back up above the market sentiment line, back into the almost 90th percentile, back almost 2% above its 30-day moving average, which is about where it's gotten to in these last few cycles. You can see we've had pretty, we're having another kind of post expiration move. The last three expiration cycles, one of them just had an extra weekend, that's why it looks a little bit longer. But we've had three expiration cycles where, like over here, we had pretty much one big expiration cycle move coming off of a low point going into the expiration cycle. Little dip in there that brought the near term line down, but not much. This expiration cycle went the whole time without a near term dip. Even though we did drop a little bit, but not enough to bring the near-term line below 40. Then we had a dip into the expiration cycle. Then another rally with a little tiny dip in the middle. Again, not very much of one. Didn't even touch the 30-day moving average. And then we continued higher, finishing with the clusters. Then we had a little dip going into towards the 30-day moving average, going into expiration. And now we're coming out of it again with another near-term. The question is, whether we'll just get one or two with a little dip in the middle. But you can kind of see the pattern right now is, there's some weakness coming into and out of expiration, and then that's quickly pushed higher, and then we just grind. So like all these, you can see we had the big push there, and then we were grinding. We had the big push there, then we were grinding, and then we had the big push here off of the low. Is actually right there, a big push there off the low, and then we just grind. So we've had our big push off the low, and now you just kind of expect to grind our way up. You can see these other moves over here. If we take a look at the directional movement index, you can see again going into these last few expiration cycles, we didn't have much of a directional move there, even though again the near term line was above 50 almost the whole time except for that little dip right there. But you can see like the positive directional index never did get above 30, and the negative got below 20 only at the very end. The ADX stayed down here, very low levels, and then you can see the pop here, the directional pop. There was that directional pop. There's this directional pop, negative pop. There's that negative pop. But this one was a directional move. You can see we did get above 30 and below 20. The ADX did rise from these really low levels, got up to 20, above 20. So we had a pretty decent run there. Then there's your expiration pop, where the negative line pops up. The positive indicator drops down. Did not get below 20, mind you. Then we had this run, which was not a very directional move. We never did. I think we got above 30 briefly there at the beginning. We got below 20 on the negative indicator at the very end again, just like we saw over here. And then there's our pop, right? About the same kind of pop that we got over here. And now can we get, again, with a very similar pop that we had here that led to a directional move, are we going to get a very similar pop that leads to another directional move coming out of this one? You can see we're not above 30 yet. We're not below 20 on the indicator. If we are going to get that pop, that directional move, then we got to get above 30 and below 20. If we just keep grinding around here like we did here, like we did here, then expect the near-term run to end when the negative indicator falls below 20, and expect the ADX to stay at extremely low levels. I mean, that's on the daily chart. Look at the ADX on the weekly chart. We had such a bullish ADX for so long. We had this big bearish move. We came down. You can see the positive indicator got above 25, got above 30. The ADX was rising up until the beginning of this year. But since the beginning of the year, we've been gradually moving lower. In fact, the negative indicator has been kind of forming higher lows. The positive indicator has been forming lower highs. And we've just been grinding. And now you can see the ADX has dropped below 20. Now, we had an ADX drop below 20 over here. But that was after some bearish moves, and same thing over here. It was after a bearish move. You notice, it's not too common for the ADX to drop below 20 after a bullish move. In fact, over here you only got the 25. You made that parabolic run up in the early 2018. Then we had those big bearish drops to the downside. Well, if you take a look, go further, and you can see over here in 2013, a very similar environment to where we're at right now. Sorry, let me make this chart so we can zoom in a little bit better. But you can see a very similar type environment in 2013 where we had a drop, a run on the ADX up to these higher levels. Again, kind of like we got above 30 this go around. If you look over here on 2013, we got above got right up to about 30, and then you can see we did drop below 20 on that rally at the very beginning of 2014. That's when tapering was announced, or at least when it started. The tapering started there, and then you can see that we didn't go bearish. We actually stayed bullish and had a pretty decent run until the ADX dropped all the way below 10 on the weekly chart. Very sideways pattern in 2015. That broke, that we had those two death cross, kind of back-to-back death crosses there. So we can kind of see, one instance of where, we had a relatively decent run, not quite as long as what we had right now. This has been a relatively, a nice and steady run. So not quite as extended, but still, it's kind of the same pattern where you got up above 20 and dropped back down below 20 on a bullish move. You don't get very many of those. Here was kind of the same thing. You got up above 30 here. You dropped below 20 in 2004. And then you can see the ADX stayed down for 2 years below 20 as we stayed bullish. But we weren't able to, we had so much up and down moves. You never really got any good trending moves going until that very last breakout pattern there in 2007 that preceded ultimately things turning around. So it's kind of interesting to see how, you can even see it up here that the candles are just getting smaller and smaller. The bodies of the candles getting smaller and smaller. If you take a look, that's reflected in the ATR as well, on a weekly chart, mind you. If I were to come over here to a weekly chart, you can see the ATR is finally dropping back below this down to this 2% mark, which is where we got to going into the COVID drop, and which is also where we got to going into the 2018 level. So we're getting down. We're at 9.5 points. It's a lot higher ATR than where we were going into COVID. It's a lot higher ATR than where we were going into the fourth quarter of 2018. But that's because the price is higher at 449. So we are definitely grinding down. In fact, one chart I saw here, where is it? Here is the new highs and new lows in the U.S. As you can see, we peaked on the highs and lows of the chart up here at the top. And let me switch to like a 1-year chart first. You can see that we peaked here, and actually let's go 2-year and let's bring in the COVID move. You can see that we peaked, how we had a good strong run. We still had a lot of stocks forming new lows. We were kind of at that 200 mark, but we had a pretty strong run. Had some pullbacks. When we get pink, that's kind of your pullbacks. Then we had a really strong move off of that November. That's where the IWM really kind of took hold, and then peaked up here in February and March. Then the IWM stopped outperforming nearly as well from a broad-based level, and we noticed we started getting lower and lower new lows, and we had pullbacks. Even though this pullback was only in the NASDAQ, that pullback was only in the NASDAQ. That little dip right there didn't quite get into the pink area, was our pullback in the Russell, and then this is, or the Dow, excuse me, and this is our pullback that we've had here lately in the Russell. And you can see the 20-day moving average of the new highs, new lows is all the way down to less than 100. It had dipped briefly there to just a little over 50 before turning slightly higher on this little run that we've had the last couple of days. So you can see another view of the grind that we have here. You can also again see that on the you can also see that here again on the number of stocks that are above their 50-day moving average. We are sitting right at the mean, even though we've been trending higher since that peak in about mid-April. We've been down. It's like it looks like we've had an intermediate pullback, though we really haven't there. And the other thing I like to take a look at here is the average 14-day RSI for the S&P 500. So we'll chart that. You can see too that peaked here in May or early May or mid-April, and since then it's been kind of steady downward here and sitting right about the mean. And again, it looks like we've had a pullback, even though we haven't necessarily had that type of move on the S&P 500. So that's what we're seeing reflected on the market forecast chart, and you see it, too, on the Russell 2000. The intermediate line turning back above 50, back above its market sentiment, a lot higher above its market sentiment, steeper curve too than what we saw on that breakout, where it's kind of a failed breakout there, never did get above 60. According to the steepness of this line, it looks like there's a good chance we get above 60, especially with a stronger near-term run that we've had in quite a while. So nice move higher on the Russell 2000, a little bit of a long upper shadow there. We'll kind of keep our eyes on. But a nice type of breakout move, dark green shading, green line. So we're going to want to see it follow through on that bullishness. If you take a look at the NASDAQ 100, which is what's fueling a lot of the recent risk appetite, you can see again strong bullish posture, bullish intermediate confirmation signal. So the intermediate line's above 80, the momentum line's below 20. That you would expect that to lead to another bullish little run to the upside. Again, it's not very much of a dip, and the near-term line's already above 80, so you wouldn't expect a big bounce up higher like we just had, where the near-term line and momentum line were down to those levels, and we had the bounce. So you wouldn't expect the same kind of bounce, but you can kind of see some of these other intermediate confirmation signals and what they can do over here and then over here. We can just expect it to grind higher and continue that trend. If we take a look at some of these other charts, let's take a look at the long-term view for the S&P 500. You can see that we have still a good bullish Heikin-Yashi candle. We've still got a strong PPO in the 91st percentile the last 3 years. It's in even more than that in the last 20 years, 95th percentile in the last 20 years. Again, another way to see the grinding. This is a normalized view, so keep that in mind. But you can see the candles is getting smaller and smaller on the Heikin-Yashi candles. Not just the regular candles, but even the Heikin-Yashi candles are getting smaller and smaller. If you take a look at the Russell 2000, with that falling PPO, you can see we've been kind of transitioned to bearish candles over the last so many weeks, and we've got a green arrow again. So we have a chance here to get back to a bullish trend on the Russell 2000, which we hadn't had. We haven't had that chance for a while. 3 green arrow chart, you can see we have 3 green arrows across the board. The Dow doesn't quite have that third green arrow there. Even the Russell 2000 has 3 green arrows. These have green lines. The Russell 2000 is just turning green. So there's green shading, green lines across the board here. So positive development there. Here's the, of course, that looks the same as it has been, but let's look at IWM, and you notice that, very strong move. We really tried to break above the 50-day moving average. I think it closed, 222.56, and I think it closed like just like, 222.51. I think is where the moving average is. So we closed like 5 cents up above there. So not quite the bullish breakout, and you can see the volume resistance that we have there at the with the point of control. So we really need to kind of hold this breakout above the 50 and push it through for this to hold. Otherwise, you always expect resistance to hold until it doesn't, and that's what's the 50-day moving average, the point of control. And if you look at the Ichimoku cloud, we have been trying to get above the cloud. It's flirting with it. We don't have the bearish move going anymore. So we need to really push through these levels if we're going to be bullish and get a new move going on the Russell that we haven't had, right? The S&P's had a move going for 9 months, almost 10, but the Russell's been sideways. Look at all that noise here. We just haven't had. We've only had a couple of almost directional moves, but not quite getting up and sustaining a direction, getting right back into noisy levels almost immediately. And there's your RSI above 60 and above 100 on the Russell, but your RSI is back above 50 and above 0, not quite above 100 on the CCI. So we're not quite breaking out here. You need to get above 60, you need to get above 100, preferably up to 200 to start the new move. That's what we need to see, and we're not there yet. Not quite on IWM. We got up to 28 on the positive, but we're still barely under 28 on the negative. It's got to get below 20 for a directional move to begin. And then if you look at the Bollinger Bands here, for SPY, of course, we're pushing up against the upper band, pushing up against the value area on the 1-year chart. But IWM, we were trying to get into the upper quartile, and we failed again. So we failed to stay up in the upper quartile. So again, not quite the bullish breakout, but close. Really, really darn close. And we were there for a good chunk of the day before, this late little drop on the intraday chart on IWM brought us back down. Remember, this common gap is still looming from Monday to fill for both of these major indexes. For the S&P, it's not that big of a deal, but for IWM, it'd be a much bigger deal, as it would be back below the value area, and we'd be back, into an area of very low volume on the 4-week chart. So, and you can see how the volume has just been gradually getting lower and lower. If you look at SPY's volume at 40 million shares, 2 days in a row, 40 million shares, 2 days in a row of exactly 1.69, or excuse me, it was 1.12 yesterday, 1.69 today on the range. So when you put that number into context, here, down here, you can see the range extremely low, the volumes extremely low at 40 million. Volatility remains at extremely low levels. That's what you expect when we're in grind mode. In fact, it looks like we closed below 0.8, just barely, but we closed below 0.8 after just getting up to 90% and getting above that 200-day moving average. So volatility, even though it's at 16.5, is still, it's not below 15, but it still has extreme lows because the VIX 3M is still pretty high, and you can also see that reflected in the high skew that we had today. If you look at the skew here, the skew jumps right back up to these extremely high levels near 160. So this goes to show the market's not too concerned about the VIX, or the 30-day mark, or the at-the-money contracts. All the interest, all the protection interest is out in time. It's out at the VIX 3M. It's out, the skew is looking further out of the money options. So the market is still, it's not very speculative. We're not seeing the gamma exposure here. Excuse me, let's go back to gamma exposure. We're not seeing the gamma exposure. It's just a very small little dip. We're We're not strongly bullish. You can see the grinding on a lot of this. And the protection, the concern about bigger, stronger moves are still out there. So, what that means is in the short term, there's not a lot of volatility expectations. We can grind higher, but just be prepared for, the tsunami to come out of nowhere, like we saw in early 2018, like we saw in other instances where we had small moves for long extended period of times. Early 2007, where we had these strong moves, big long intermediate rallies, longer than normal, and then they produced that boom, one day out of nowhere move where all of a sudden we've fallen here, whatever it is, 3%. Let's see, where's our daily moves on this chart? We'll come out of nowhere and get a 2-3% drop, with a 0.75% or 0.2% gap to the downside that sparks it overnight. So they will come out of nowhere and spark that jump and volatility. It's just not going to happen yet, at least, when the volatility index, the indicator, is sitting at 80%, right? Until then, we have to start to grind our way back up, and usually that kind of move will come from the VIX being at 90% or in this range, and then you just jump up to 105, up to 115. So that's kind of what I'm expecting. I don't expect that kind of that move to come anytime soon. I expect that we'll continue to grind really slowly and softly over the next expiration cycle, as been the current trend, until we see something different. So we'll continue to trade it like we have been trading it over the last so many months, especially in our market scholars trading rooms. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. Whether you're a lot more bullish than I am, a lot more bearish than I am, share what's driving that, whatever chart or indicators you're looking at down in the comment section below. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also hit that thumbs up icon. That tells us that you liked our video today and then you want us to do another video again tomorrow. Comment down below and anything that stood out to you. Questions, comments, anything that you had about what I discussed in the video, post those in the comments section. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. If you're watching us on our blog, we have our Market Outlook live video here on the right of the video, as well as our upcoming trading rooms. Come down here to the bottom, click on that heart, opens up a new tab. Hit that like button right there. Also click this thumbs up icon, opens up another new tab. Hit that like button as well. Again, the more you do that, it helps us get our content out to more of our followers, because that's how these algorithms work. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us here. All right, now let's take a look at what's driving a lot of this price action. And before, we had talked about how a lot of these risk asset classes, the euro being the flip side of the dollar here, crude oil prices, emerging markets, silver, copper, all of these, the 10-year yield have all been kind of in dark pink shading and red lines. Well, you notice now, like the 10-year yields have dark green shading and the yellow line. And you can see how stocks are bouncing back up here. This is the global ETF that represents the global market. Bitcoin still on the dark green shading and the green line. Gold is kind of flattening out with a red line there. SPY is up. And IWM, which had been the other, we've been using that too as a risk asset class too. It's turned dark green shading in the green line. So it seems like we are starting to, at least we're off of those pre-expiration lows that were just so bearish across all these different asset classes and moving to the upside. And part of that is this move here that we've seen. Where is it? Right here. In the last 4 days, right? If you go to August the 20th and go into how things have performed over these last 4 days, you'll notice small cap stocks, commodities, emerging markets all really rising to the upside. QQQ is kind of lagging, but still up almost 3%. And then your safe havens down at the bottom: long-term bonds, the dollar, real estate, gold, all lagging behind. Gold dropping below high-yield bonds there. Well, I've shown you this before, but there's continues to be a reason since we peaked in July, on July 1st, from July 2nd going into the 20th. You can see the biggest losers were, that what we see there. There's a reason why these asset classes jumped so much, because they were the biggest losers, and your safe havens up here were the winners, including QQQ, which has been acting as a safe haven. So whenever you go out to include the last 4 days, you'll notice that commodities are still negative since that July 1st peak. That small cap stocks are still negative by 4%. Emerging markets are still negative by 6%. So there's a reason why they've rallied as much as they have. It's because they were down so much. And what was working, long-term bonds, real estate, you can see they're down. They're still positive. Even the dollar is still positive. But they're just giving back some of their gains, and money's moving into some of these things. Now the question is whether they'll turn back around completely and flip this script and keep this little trend that we've had going over the last 4 days, if that will keep going to the upside. That's the big question. And whether or not we'll see over these next couple of days that will end up being the case. If I take a look at like the dollar, the US dollar, where that euro made that big push higher a few days ago, it's kind of followed through with some strength into, this is just today starting, but it's kind of followed through with some strength, but still hasn't been able to get above that moving average. We're still in bearish territory here, so we haven't quite flipped back into bullish level or even gotten into the neutral territory. And if you take a look at its 2-line version of the MACD, of the 3 green arrow chart, you can also see too that there it is, kind of trading at that 23 or 78% line here. Multiple Fibonacci lines sitting up here, and you're also sitting between the 17 and the 30-day moving average. Breaking through both of them together as a bullish line, not trading between them is not necessarily the most bullish. And you see, you've got the 50-day. So your next kind of breakout move will be to break above, the 23% line here, this blue 23% line. We can probably get rid of some of these just for some clarity's sake. This is that big long-term line that we had been on. We'll just take them all off for now. But you can see that's the current run that we're on, this intermediate decline. So until you get above that 23% line, you're still on this decline, right? We don't start retracing until you break above that, which would probably mean a break above the 30 and the 50, and then you'd really be bullish. From a commodity standpoint, again, you can see the rally that we've had the last few days. Today, getting above the 30 and the 50, and to the top of this little volume node, getting through here will be really key to making sure that we're back to being bullish again on a high level, right? And long-term bonds showing risk off moves. You can see that we have traded between the 30 and the 50-day moving average down towards this 23% retracement level, this 50% line, the 23% line being here. Let me get rid of some of these lines here so we can see here's the current move. So again, we are flirting with that 23% line, but not really breaking down yet below that 23 and 38 to where we're like, okay, here we go, risk on to the upside. Gold also kind of figuring out what it's trying to do here with a very strong support down below it too. Risk on moves would really push us through that level to the downside and get us going, push us back below this 23% line and really get back going towards 157. So you can see it looks like we're pointed that direction on a lot of these asset classes, but not really breaking out per se. And so that's kind of why we're at where we're at. If you take a look at this sector, if you kind of look at the sector comparison the same way, we had been dark pink shading and a red line on these lines, but you notice we're dark green shading and green line all across the board. So except for in poor energy, which has been struggling, and your safe havens, which are pulling back a little bit, 73 and a 76, so still high numbers, but falling. And you can see utilities as a falling intermediate line as well. They're just giving back some of their gains. So it's the same idea. If you look at the same, let's see, is it this one? If you go back to, again, that same July 2nd time frame up until the 19th, you can see what was working. There's your safety trades, staples, real estate, healthcare, utilities all up. Technology acting as a safety sector. That's why QQQ. And there's energy down 16% since that peak. Well, now, including the last 4 days, the 20th through the 25th, you can see the energy is still down 11%. So it rallied. It's gone up the most because it was so far down the most. And utilities and healthcare and staples are pulling back, but they're still strongly positive. And some of these areas like industrials, discretionary, which had been negative going into the 19th, going into, I believe that was the Fed minutes there, or that might have been on the 18th. But you can see the period where they rallied off of that low point right around noon my time on the 19th. They were negative. Discretionary industrials were more negative than others, and so they've been up more than others over this time frame. That's how this works. Here's the 20th going forward from here. Let's go to a 10-minute chart. So there's discretionary, there's materials, industrials, there's financials and energy. They're rallying the most, along with technology too, but they're rallying the most because they were down the most. And your safe havens are giving back some. You notice they're not down nearly as much as these are up. They're just giving back some of those gains. And again, we haven't flipped the script. All we've done is exhaled. We've had a really strong move in risk aversion in everything except for XLK / QQQ / ultimately SPX. But everything else has been, in risk aversion mode. And right now we're just kind of exhaling that risk aversion. And now it's a matter of whether we are trending back towards risk appetite. And it looks like I said, we're pointed that direction. We just haven't broken out to it yet. Or are we going to inhale again on a new leg lower? And so we're kind of at that point. You would expect, again, considering the strength of the trend, that we would still be in a risk aversion mode until we get a good exhale on a broad level. But the last few expiration cycles suggests that we'll probably get kind of a risk off but grind higher in these large cap areas that will keep the S&P moving upwards. Grind is small upwards, but upwards nonetheless until we get to that next expiration cycle. So for our trade idea of the day, I want to take a look at Penn National Gaming. You can see it had a nice little breakout. The intermediate line breaking up above the 60th percentile, so getting into bullish territory for the first time in months, as you can see here. Getting well up above its 30-day moving average, so a good strong breakout move. You can see from a 3 green arrow standpoint here, we obviously have 3 green arrows and a spike in volume today. So nice breakout. We're not quite breaking above that 23% line. As you can see, that's on the downward move. So, you get above that, you can see the move up to 100, up to the midpoint or higher to 125 is to the top of the retracement zone. So that's kind of your potential. If you take a look at some of the Bollinger Bands for Penn, you can see that we are at the top of the the volume node is down here between the 23 and 0% line. So if we break above that 23, we get into the low volume areas, and of course getting above the 38%, now you're above the value area. So we'd really get a good bullish trend to come out of this. You can see some of these indicators show strong trending breakout moves above 60 on the RSI, nearly above 200 on the CCI. Look at the directional movement index, and you can see that we're above 30, almost a 35 on the positive, well, easily below 20 on the negative. And then you can see too, if you look at the Ichimoku cloud here, we are also breaking up above the cloud. Now we don't have a strong trend yet, but again, kind of shows the potential trending move where we're still not quite above 50. We're not above 1 yet. So, but we're above the cloud, and you can see where that potential lies. So really good opportunity for a directional move on Penn National Gaming. So what we decided to do is we come over here to the October options, sell the 95 strike, buy the 90 strike. What that does is it gives us a long call, an opportunity to get up to here. Let me get rid of the there we go. Get up here to $95, which is well within 1 standard deviation. of where we're currently at. And you can see a small risk, half of what we normally risk on a trade, $500, going for about a 4-to-1 reward to risk ratio in the worst case scenario. Of course, if we break back down, we'll get out with a $200-300 loss. So we probably won't take the full $500 loss, but you can see what the reward potential is if it works out and follows through on this breakout that it's having. All right, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. I'll open up any new thread there, reply to anybody else's threads with any questions or comments you have. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel as well as to our website at marketscholars.com. Click that thumbs up icon, like us on Twitter and Facebook as well, comment on the video. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.